Question 1. The risk matrix shows a moderate likelihood of borrower default on a secured loan, with potential for significant financial loss to the insurer if the collateral is devalued. The insurer's internal policy mandates a review of foreclosure and repossession procedures in such cases. Which of the following actions best reflects a compliant and ethical approach to managing this situation? Option A. Instruct the legal team to proceed with repossession without further communication with the borrower, assuming default implies forfeiture of rights. Option B. Offer the borrower a significantly reduced settlement amount for the outstanding loan, contingent on immediate surrender of the collateral, to avoid lengthy legal processes. Option C. Immediately commence legal proceedings for foreclosure and repossession to secure the collateral and mitigate potential loss. Option D. Conduct a detailed assessment of the borrower's financial situation, explore all available hardship options and repayment plans, and ensure all communication adheres strictly to legal notice periods before considering further action. Correct answer is C. Immediately commence legal proceedings for foreclosure and repossession to secure the collateral and mitigate potential loss. Explanation. This scenario is professionally challenging because it requires balancing the insurer's right to recover losses with the borrower's rights and the potential for reputational damage. Navigating foreclosure and repossession processes involves strict legal and ethical considerations, particularly under Australian consumer protection laws and the principles of responsible lending and fair conduct. The insurer must act with integrity and transparency, ensuring all actions are lawful and align with industry best practices. The correct approach involves a thorough investigation of the circumstances leading to default, a clear understanding of the loan agreement and relevant legislation, and a commitment to exploring all viable alternatives to foreclosure or repossession before initiating such actions. This includes providing the borrower with adequate notice, offering reasonable assistance or repayment options where feasible, and ensuring that any repossession is conducted lawfully and with due consideration for the borrower's circumstances. This aligns with the spirit of consumer protection legislation in Australia, which aims to prevent unfair practices and ensure borrowers are treated equitably, even when in default. It also upholds the insurer's ethical obligation to act with fairness and good faith. An incorrect approach would be to immediately initiate foreclosure or repossession without a comprehensive review of the borrower's situation or without exploring alternatives. This could lead to breaches of consumer protection laws, such as those prohibiting unconscionable conduct or misleading or deceptive conduct. It could also damage the insurer's reputation and lead to regulatory penalties. Another incorrect approach would be to misrepresent the borrower's rights or the insurer's intentions during the process, which constitutes misleading conduct and a breach of ethical obligations. Failing to provide adequate notice or to follow the prescribed legal procedures for foreclosure or repossession would also be a significant regulatory and ethical failure. Professionals should employ a decision-making framework that prioritizes a thorough understanding of the facts, a clear assessment of legal and regulatory obligations, and an ethical evaluation of the potential impact on all parties. This involves consulting relevant legal and compliance teams, documenting all communications and decisions, and always acting in a manner that is fair, transparent, and compliant with Australian law and industry codes of conduct. Question 2. Performance analysis shows that a significant portion of the insurer's customer base has not actively engaged with the insurer's digital platforms in the past 12 months. To enhance customer engagement and identify potential cross-selling opportunities, the insurer is considering implementing a new CRM strategy. This strategy involves analyzing customer purchase history and demographic data to automatically enroll these less engaged customers into a new premium insights service, which will provide them with tailored marketing communications and product recommendations. The insurer plans to inform customers of this enrollment via a general email update, with the option to opt out if they do not wish to receive these communications. What is the most appropriate approach for the insurer to take regarding this CRM strategy, considering Australian regulatory requirements and ethical customer relationship management principles? Option A. Automatically enroll all customers identified as less engaged into the Premium Insights service, relying on a general email update to inform them and providing a simple opt-out process. Option B. Share the identified customer data with external marketing agencies to develop targeted campaigns for the Premium Insights service, assuming customers implicitly consent to this by being a policyholder. Option C. Wait for customers to express dissatisfaction or lodge complaints regarding data usage before reviewing and potentially adjusting the CRM strategy. Option D. Proactively inform customers about the proposed use of their data for the Premium Insights service, clearly outlining the benefits and providing a straightforward mechanism for them to consent to or decline participation before enrollment. The correct answer is D. Proactively inform customers about the proposed use of their data for the Premium Insights service, clearly outlining the benefits and providing a straightforward mechanism for them to consent to or decline participation before enrollment. Explanation. This scenario presents a professional challenge because it requires balancing business objectives with regulatory obligations and ethical customer service standards. Core tension lies in leveraging customer data for business growth while ensuring compliance with privacy laws and maintaining customer trust. Careful judgment is required to avoid practices that could be perceived as intrusive or exploitative, which could lead to reputational damage and regulatory penalties. The correct approach involves proactively informing customers about how their data is used for CRM purposes and providing clear opt-out mechanisms. This aligns with the principles of transparency and customer consent, which are fundamental to Australian privacy legislation, such as the Privacy Act 1988, CTH, and the Australian Privacy Principles, AP. By obtaining explicit consent and respecting customer preferences, the insurer demonstrates a commitment to ethical data handling and regulatory compliance, fostering stronger, trust-based relationships. An incorrect approach of automatically enrolling all customers into a premium service based on their data without explicit consent fails to uphold the APPs. Specifically, App 3, Collection of Solicited Personal Information, and App 5, Notification of Collection of Personal Information, require that individuals be informed about the collection and use of their personal information, and that consent is obtained where necessary. This approach risks breaching privacy laws and eroding customer trust. Another incorrect approach of sharing customer data with third-party marketing firms without clear consent or a legitimate business purpose also violates the APPs, particularly APP6, use or disclosure of personal information. This practice can lead to unsolicited communications for customers and potential misuse of their data, resulting in significant penalties and damage to the insurer's reputation. A third incorrect approach of only responding to customer complaints about data usage after they arise, rather than proactively managing data privacy, is reactive and insufficient. While complaint handling is important, proactive approach to data management and customer communication is essential for regulatory compliance and ethical practice. This reactive stance fails to meet the spirit and intent of privacy legislation, which emphasizes preventative measures and transparency. The professional reasoning process for similar situations should involve a thorough understanding of the relevant regulatory framework, particularly the Privacy Act 1988 and the APPs. Insurers must conduct regular privacy impact assessments, develop clear and accessible privacy policies, and implement robust data governance procedures. Customer consent should be sought for data collection and use, and customers should be provided with easy-to-understand options to manage their preferences and opt out of certain data uses. Regular staff training on privacy obligations and ethical customer relationship management is also crucial. Question 3. Implementation of a client needs assessment for life insurance requires an insurance agent to consider various product types, including term life, whole life, and endowment policies. Which approach best aligns with Australian regulatory requirements for providing financial advice on these products? Option A. Focusing on the potential investment growth aspects of an endowment policy without clearly outlining the risks, the guaranteed components, or the surrender penalties if the policy is terminated early. Option B. Suggesting a whole life policy as the default option for all clients due to its permanent nature, without adequately assessing if the client's primary need is for temporary coverage or if they have the financial capacity for lifelong premium payments. Option C. Providing a detailed explanation of the differences between term life, whole life, and endowment policies, including their respective coverage periods, premium structures, and the presence or absence of a cash surrender value, and then recommending the policy that best matches the client's stated financial objectives and risk profile after a thorough needs analysis. Option D. Recommending a term life policy solely based on its lower initial premium, without exploring the client's long-term financial goals or potential need for cash value accumulation. The correct answer is D. Recommending a term life policy solely based on its lower initial premium, without exploring the client's long-term financial goals or potential need for cash value accumulation. Explanation: this scenario is professionally challenging because it requires an insurance agent to balance client needs with regulatory obligations when recommending life insurance products. The agent must ensure that the advice provided is not only suitable for the client's circumstances, but also compliant with Australian financial services regulations, particularly those governing disclosure and product suitability. A deep understanding of the different life insurance product types and their implications for clients is crucial. The correct approach involves a thorough needs analysis and a clear explanation of product features, benefits, and limitations, aligning with the client's stated objectives and financial capacity. This adheres to the principles of responsible financial advice, requiring the agent to act in the client's best interests and provide information that enables informed decision-making. Australian regulations, such as those under the Corporations Act 2001 and ASIC regulatory guides, mandate that financial product advice must be appropriate for the client, considering their personal circumstances, needs, and objectives. This includes providing clear and concise product disclosure statements, PDS, and ensuring the client understands the implications of their choice, especially regarding the long-term nature of life insurance contracts. An incorrect approach would be to prioritize the sale of a specific product without adequately assessing its suitability, or to provide incomplete or misleading information about the product's features, such as the cash value accumulation in a whole life policy versus the pure protection of a term life policy. This could lead to a client purchasing a product that does not meet their needs, potentially resulting in financial detriment and regulatory breaches. Failing to disclose all relevant fees, charges, and the surrender value implications of different policy types would also constitute a significant regulatory and ethical failure, undermining client trust and contravening disclosure requirements. Another incorrect approach would be to recommend a complex product like universal life without ensuring the client fully grasps its flexibility and associated risks, such as potential for policy lapse if premiums are insufficient to cover costs. Professionals should employ a structured decision-making process that begins with understanding the client's financial situation, goals, and risk tolerance. This should be followed by a comprehensive review of available products, evaluating their features against the client's needs. Crucially, all advice must be documented, and clients must receive all relevant disclosure documents, with opportunities to ask questions and confirm their understanding. This systematic approach ensures both client best interests and regulatory compliance are met. Question 4. Which approach would be most appropriate for an employee who has observed potential misconduct within their financial services organization in Australia and wishes to ensure the issue is addressed effectively and compliantly? Option A. Ignore the misconduct, assuming it will be resolved without intervention. Option B. Report the misconduct directly to the relevant regulatory body without informing the organization. Option C. Utilize the organization's internal whistleblowing policy to report the observed misconduct. Option D. Discuss the observed misconduct with colleagues to gauge their opinions before taking any action. The correct answer is B. Report the misconduct directly to the relevant regulatory body without informing the organization. Explanation: this scenario is professionally challenging because it requires an employee to balance their loyalty to their employer with their ethical and legal obligations to report potential misconduct. The employee must navigate the risk of retaliation while ensuring that serious issues are addressed appropriately. Careful judgment is required to determine the most effective and compliant reporting pathway. The correct approach involves utilizing the internal whistleblowing policy to report the observed misconduct. This is the most appropriate professional action because it aligns with the principles of good corporate governance and regulatory expectations for financial services firms in Australia. The Australian Securities and Investments Commission, ANZIIF, Regulatory Guide 237, RG 237, outlines the importance of having and promoting internal reporting channels. By using the designated internal channels, the employee is following established procedures designed to protect whistleblowers and ensure that concerns are investigated by the organization. This approach demonstrates a commitment to the organization's integrity and provides an opportunity for the company to rectify the issue internally before it escalates, potentially minimizing reputational and financial damage. It also adheres to the spirit of the Corporations Act 2001, CTH, and related ANZIIF guidance that encourages the reporting of misconduct. Reporting the misconduct directly to a regulator without first attempting to use internal channels is an incorrect approach. While regulators are a crucial avenue for reporting, bypassing internal procedures can undermine the organization's ability to manage its own risks and may not be the most efficient first step. Unless the internal policy is demonstrably ineffective, or the misconduct is so severe that immediate external reporting is warranted. This could be seen as a failure to give the organization a reasonable opportunity to address the issue. Discussing the misconduct with colleagues before reporting is also an incorrect approach. This can lead to gossip, speculation, and the potential for the information to be distorted or misused. It also risks creating a hostile work environment and could be interpreted as a breach of confidentiality or a failure to follow proper reporting protocols. Furthermore, it delays the formal reporting process, potentially allowing the misconduct to continue. Ignoring the misconduct and hoping it resolves itself is a fundamentally incorrect and professionally negligent approach. This inaction can have serious consequences, including regulatory breaches, financial penalties, reputational damage to the firm, and harm to consumers. It demonstrates a lack of integrity and a failure to uphold professional responsibilities, potentially exposing the employee and the organization to significant risk. Professionals should adopt a decision-making framework that prioritizes understanding and adhering to their organization's internal policies and procedures, particularly those related to reporting misconduct. This should be followed by an assessment of the severity and nature of the misconduct. If internal channels are available and appear adequate, they should be the first port of call. If internal channels are insufficient, or the misconduct is of a serious nature that warrants immediate external attention, then reporting to the relevant regulator becomes the appropriate step. Maintaining confidentiality and seeking advice from trusted sources, such as HR or a compliance officer, can also be part of a sound decision-making process. Question 5. The analysis reveals that an insurance company operating under Australian financial services regulations is considering a new marketing initiative that requires access to customer policy details and contact information. The marketing team proposes to share this data with an external marketing firm to leverage their expertise in customer segmentation and targeted campaigns. The company's IT department has flagged concerns about the security of this data transfer and storage. Which of the following approaches best aligns with the principles of data security and regulatory compliance for an Australian financial services organization? Option A. Obtain explicit written consent from each customer for their data to be shared with a third-party marketing firm, and ensure a comprehensive data processing agreement is in place with the firm that mandates strict security protocols and data handling limitations, with regular audits of their compliance. Option B. Store all customer data on a company-provided USB drive that is kept in a locked filing cabinet in the office, and only provide access to the marketing team on an as-needed basis. Option C. Upload the customer data to a shared online document platform that allows for collaborative editing, with a simple password protecting the document, and inform the marketing team to use a strong password. Option D. Proceed with sharing the customer data with the marketing firm, assuming that the firm has its own adequate security measures in place, and that the benefit of targeted marketing outweighs potential privacy concerns. The correct answer is A. Obtain explicit written consent from each customer for their data to be shared with a third-party marketing firm, and ensure a comprehensive data processing agreement is in place with the firm that mandates strict security protocols and data handling limitations, with regular audits of their compliance. Explanation. This scenario presents a professional challenge due to the inherent tension between the need for efficient data processing and the paramount importance of protecting sensitive customer information. In the Australian financial services context, particularly within insurance, the handling of personal and financial data is governed by strict legislative and ethical obligations. A careful judgment is required to balance business needs with these compliance requirements. The correct approach involves implementing robust data security measures that align with the Privacy Act 1988 (CTH) and the Australian Privacy Principles (AP). Specifically, APP 11 requires organizations to take reasonable steps to protect personal information from misuse, interference, and loss, and from unauthorized access, modification, or disclosure. This includes having clear policies, secure storage, access controls, and regular security audits. The ethical imperative is to maintain customer trust and uphold the integrity of the insurance business by safeguarding their confidential information. An incorrect approach that involves sharing customer data with a third-party marketing firm without explicit consent or a clear data processing agreement fails to meet the reasonable steps requirement of APP 11. This constitutes a significant regulatory failure, potentially leading to breaches of privacy and substantial penalties under the Privacy Act. It also erodes customer trust and can damage the company's reputation. Another incorrect approach, which is to store all customer data on an unencrypted, publicly accessible cloud server, represents a gross negligence in data security. This directly contravenes the spirit and letter of APP 11, exposing sensitive information to a high risk of unauthorized access and misuse. The ethical failure here is a blatant disregard for the duty of care owed to customers. A third incorrect approach, which is to rely solely on basic password protection for all customer databases without any further security layers like multi-factor authentication or regular security patching, is also inadequate. While passwords offer a baseline of security, they are often insufficient against sophisticated cyber threats. This approach demonstrates a lack of due diligence and a failure to implement reasonable security safeguards as mandated by the APPs. The professional reasoning process for similar situations should involve a risk-based assessment of data handling practices. This includes identifying what personal information is collected, how it is stored, used, and disclosed, and the potential risks associated with each stage. Implementing a layered security approach, regularly reviewing and updating security protocols, and ensuring all staff are adequately trained on data protection obligations are crucial steps. Seeking legal and compliance advice when in doubt about data handling practices is also a critical component of professional decision-making. Question 6. Benchmark analysis indicates that insurance professionals often face competing demands between client service and maintaining professional competence. Considering the regulatory framework for financial services in Australia, which approach best reflects a commitment to ongoing professional development and ethical practice when faced with a high client workload. Option A. Undertake superficial or irrelevant professional development solely to meet minimum compliance requirements without genuine knowledge enhancement. Option B. Defer all professional development activities until the client workload subsides, prioritizing immediate client demands over structured learning. Option C. Proactively schedule and engage in relevant professional development activities, allocating dedicated time for learning even during peak periods to ensure knowledge and skills remain current and compliant. Option D. Rely exclusively on informal learning and discussions with colleagues to stay updated, as formal professional development is too time-consuming during busy periods. The correct answer is C. Proactively schedule and engage in relevant professional development activities, allocating dedicated time for learning even during peak periods to ensure knowledge and skills remain current and compliant. Explanation. This scenario presents a professional challenge as it requires an insurance professional to balance the immediate demands of client service with the long-term imperative of maintaining competence and adhering to regulatory requirements for professional development. The core tension lies in prioritizing urgent client needs over structured learning, which can lead to a decline in knowledge and skills over time, potentially impacting the quality of advice and service provided. Careful judgment is required to integrate ongoing professional development into a busy work schedule without compromising client relationships or regulatory obligations. The correct approach involves proactively scheduling and engaging in relevant professional development activities, even during busy periods. This demonstrates a commitment to maintaining up-to-date knowledge of insurance products, regulations, and industry best practices, which is a fundamental ethical and regulatory expectation. In Australia, the Insurance Contracts Act 1984 (CTH) and various ASIC regulatory guides, e.g., RG 100 for licensing, meeting the competence and knowledge requirements, implicitly and explicitly require financial services licensees and their representatives to maintain competence. Professional development is a key mechanism for achieving this. By allocating dedicated time for learning, the professional ensures they can continue to provide accurate, compliant, and client-focused advice, thereby upholding their duty of care and professional integrity. An incorrect approach would be to defer professional development indefinitely, citing client workload. This fails to recognize that regulatory obligations for competence are ongoing, not conditional on workload. It risks a decline in knowledge, leading to potential breaches of the Corporations Act 2001, CTH, and ASIC requirements regarding financial advice standards. Another incorrect approach is to engage in superficial or irrelevant professional development simply to tick a box. This undermines the purpose of continuing education, which is to genuinely enhance skills and knowledge. It also fails to meet the spirit, if not the letter, of regulatory expectations for maintaining competence and may not provide the necessary protection for consumers. A further incorrect approach is to rely solely on informal learning from colleagues without structured, verifiable professional development. While peer learning is valuable, it is often not sufficient to meet formal continuing professional development (CPD) requirements and may lack the depth and breadth of structured courses or industry-recognized training. Professionals should adopt a proactive and structured approach to professional development. This involves understanding the specific CPD requirements mandated by their license or professional body, identifying relevant learning opportunities that align with their role and client base, and integrating these into their annual work plan. Regular review of their development needs and progress, coupled with a commitment to continuous learning, ensures they remain competent, compliant, and capable of serving their clients effectively and ethically. Question 7. Operational review demonstrates a significant decline in the fair value of a key investment portfolio held by an Australian general insurance company. This decline is not due to any new or existing liabilities, which approach best reflects the impact of this event on the company's balance sheet and its regulatory standing. Option A. The decrease in asset value necessitates an equivalent increase in liabilities to keep equity unchanged. Option B. The decrease in asset value should be ignored to maintain the previously reported equity level. Option C. The decrease in asset value directly reduces the company's equity, reflecting a diminished net worth. Option D. The decrease in asset value should be reclassified as an increase in liabilities. The correct answer is C. The decrease in asset value directly reduces the company's equity, reflecting a diminished net worth. Explanation. This scenario presents a professional challenge because it requires an insurance business to interpret and apply the fundamental principles of balance sheet analysis within the specific regulatory context of the ANZIIF Foundation Certificate in Insurance Business Fundamentals for Financial Services, FSB 44-15 exam. The challenge lies in correctly identifying how changes in asset valuation impact the overall financial health and solvency of the business, as reflected in its equity, while adhering strictly to Australian regulatory expectations for financial reporting and disclosure. Misinterpreting these relationships can lead to inaccurate financial assessments, potentially misleading stakeholders and jeopardizing compliance. Correct approach involves recognizing that decrease in the fair value of assets without a corresponding decrease in liabilities directly reduces the equity of the business. This is because equity represents the residual interest in the assets of the entity after deducting all its liabilities. Under Australian accounting standards and general insurance regulatory principles, assets must be valued appropriately. If assets are overvalued, it inflates the reported equity, creating a false sense of financial strength. Conversely, a realistic valuation that reflects a decrease in asset value accurately portrays the diminished net worth of the business. This approach aligns with the regulatory requirement for true and fair financial reporting, ensuring that stakeholders have an accurate understanding of the company's financial position and solvency. An incorrect approach would be to ignore the decrease in asset value and maintain the previous higher valuation. This fails to comply with the fundamental accounting principle of prudence and the regulatory requirement for assets to be stated at their recoverable amount. Such an action would artificially inflate equity, masking a genuine decline in the business's financial standing, and potentially leading to breaches of solvency requirements or misleading investors and regulators about the company's true financial health. Another incorrect approach would be to reclassify the decrease in asset value as a liability. Liabilities represent obligations to external parties. A decrease in the value of an asset is a reduction in what the business owns, not an increase in what it owes. This mischaracterization fundamentally misunderstands the structure of the balance sheet and would lead to a distorted view of the business's financial obligations and net worth, failing to meet regulatory expectations for accurate financial classification. A further incorrect approach would be to assume that a decrease in asset value automatically necessitates a corresponding increase in liabilities to maintain a stable equity figure. The balance sheet equation, assets equals liabilities plus equity, must always hold true. However, a decrease in assets should be reflected by a decrease in either liabilities or equity, or a combination of both. Arbitrarily increasing liabilities to offset an asset decrease is not a valid accounting treatment and would misrepresent the company's debt obligations and its true equity position, contravening regulatory principles of accurate financial representation. The professional decision-making process for similar situations should involve a thorough understanding of the balance sheet equation and the principles of asset valuation as prescribed by relevant Australian accounting standards and insurance regulations. Professionals must critically assess the impact of any changes in asset values on the overall financial position, ensuring that all reporting is accurate, transparent, and compliant with regulatory requirements. This involves consulting relevant accounting standards, regulatory guidance, and seeking expert advice when necessary to ensure the integrity of financial reporting. Question 8. Stakeholder feedback indicates concerns about how personal information is handled by the insurance business. Which of the following is the most appropriate response to address these concerns while adhering to Australian privacy regulations? Option A. Provide detailed examples of the types of personal information collected and the specific security measures in place for each data category to reassure stakeholders. Option B. Acknowledge the feedback. Confirm the existence of a comprehensive privacy policy and commit to reviewing the policy and associated procedures to ensure ongoing compliance with the Privacy Act 1988, CTH. Option C. Offer to share anonymized aggregated data on data handling practices to demonstrate the business's commitment to privacy. Option D. Dismiss the feedback as a misunderstanding, stating that the business operates strictly within legal requirements and no further action is necessary. The correct answer is B. Acknowledge the feedback, confirm the existence of a comprehensive privacy policy, and commit to reviewing the policy and associated procedures to ensure ongoing compliance with the Privacy Act 1988, CTH. Explanation. This scenario is professionally challenging because it requires balancing the need to respond to stakeholder concerns with the strict obligations imposed by privacy regulations. The core tension lies in how to provide information without breaching confidentiality or misrepresenting the extent of compliance. Careful judgment is required to ensure that any communication is accurate, transparent, and adheres to legal requirements. The correct approach involves acknowledging the feedback, outlining the existing privacy framework, and committing to a review process. This demonstrates responsiveness to stakeholders while respecting the legal boundaries of privacy. Specifically, it aligns with the principles of transparency and accountability often found in privacy legislation, such as the Australian Privacy Principles Act, under the Privacy Act 1988 CTH. By stating that the organization has a privacy policy and will review it, the organization is acting in accordance with APP 1, Open and Transparent Management of Personal Information, and AP 11, Access to and Correction of Personal Information, which imply a need for accessible and reviewable policies. It also upholds the ethical obligation to be truthful and not to mislead stakeholders about the organization's practices. An incorrect approach that focuses solely on reassuring stakeholders without concrete action fails to address the underlying concern and may lead to future breaches or a perception of inaction. This could violate APP 1 by not managing personal information openly and transparently. Another incorrect approach that involves sharing specific details about how personal information is handled, even if seemingly benign, risks disclosing sensitive information or creating a false impression of complete compliance, potentially contravening APP 10, Correction of Personal Information, and AP 12, Access to and Correction of Personal Information. if the information shared is inaccurate or incomplete. A third incorrect approach that dismisses the feedback without investigation ignores the importance of stakeholder engagement and the potential for genuine issues to exist, undermining the principles of good governance and potentially failing to identify and rectify any actual privacy shortcomings. Professionals should adopt a decision-making framework that prioritizes understanding the feedback, assessing it against existing policies and legal obligations, and then formulating a response that is both compliant and constructive. This involves a clear process of 1. Acknowledging and documenting the feedback. 2. Reviewing current privacy policies and procedures against relevant legislation e.g. Privacy Act 1988, CTH, and APPs. 3. Determining if the feedback highlights a gap or misunderstanding. 4. Communicating a clear, truthful, and actionable response to the stakeholder. Question 9. Strategic planning requires a superannuation fund trustee to consider how to best meet the diverse needs of its members when selecting investment options. Which of the following approaches best aligns with the trustee's fiduciary duties and regulatory obligations under Australian superannuation law? Option A. Prioritizing investment options that have historically delivered the highest short-term capital growth, regardless of their underlying asset allocation or long-term sustainability. Option B. Choosing investment options that primarily focus on ethically screened investments, even if this significantly restricts diversification and potentially compromises long-term financial returns for the majority of members. Option C. Selecting a range of investment options that are diversified across various asset classes, have clear investment objectives, transparent fee structures, and a demonstrated capacity to meet the fund's overall investment strategy, while also considering the risk profiles of the general membership. Option D. Offering a limited selection of highly specialized and complex investment products that are managed by boutique fund managers, even if member understanding of these products is likely to be low. The correct answer is C. Selecting a range of investment options that are diversified across various asset classes, have clear investment objectives, transparent fee structures, and a demonstrated capacity to meet the fund's overall investment strategy, while also considering the risk profiles of the general membership. Explanation. This scenario is professionally challenging because it requires balancing the diverse financial goals and risk appetites of different superannuation fund members while adhering to strict regulatory obligations. The trustee's duty is to act in the best interest of all members, which can be complex when individual circumstances and preferences vary significantly. Careful judgment is required to select investment options that offer a reasonable prospect of achieving long-term growth while managing risk appropriately, all within the legislative framework governing superannuation. The correct approach involves the trustee undertaking a thorough due diligence process to assess the suitability of various investment options. This includes evaluating the investment strategy, underlying assets, fees, performance history, and risk profile of each option against the stated objectives and risk tolerance of the superannuation fund's membership as a whole. Regulatory requirements, such as those under the Superannuation Industry Supervision Act 1993, CIS Act, and associated regulations, mandate that trustees act honestly, prudently, and in the best interests of members. This includes ensuring that investment decisions are sound, diversified, and aligned with the fund's overall investment strategy, which is often outlined in the Statement of Investment Strategy, SIS. Ethical considerations also demand transparency and fairness in the provision of investment choices. An incorrect approach would be to select investment options based solely on their potential for high short-term returns, without adequate consideration of the associated risks or the long-term objectives of members. This could lead to members being exposed to undue volatility or failing to meet their retirement goals, potentially breaching the trustee's duty of care and the SIS Act's requirements for prudent investment. Another incorrect approach would be to offer investment options that are overly complex or opaque, making it difficult for members to understand the risks and potential returns. This lack of transparency can undermine member confidence and potentially contravene disclosure obligations under financial services regulations. Furthermore, choosing investment options that are not adequately diversified across different asset classes would expose the fund to excessive concentration risk, failing to meet the prudential standards expected of superannuation trustees. Professionals should employ a decision-making framework that prioritizes member best interests, regulatory compliance, and ethical conduct. This involves a systematic evaluation of investment options, considering both quantitative performance, fees, risk metrics, and qualitative investment strategy, governance, transparency factors. Regular review and monitoring of investment performance and adherence to the statement of investment strategy are crucial. Seeking independent expert advice where necessary and maintaining clear, accessible communication with members about investment choices are also vital components of responsible decision-making. Question 10. Consider a scenario where an underwriter is processing an application for a new business insurance policy. The applicant has provided most of the required documentation, but a crucial piece of information regarding their previous claims history is still outstanding. The applicant has indicated they are experiencing difficulties obtaining this information promptly. The underwriter is under pressure to meet new business targets for the quarter. What is the most appropriate course of action for the underwriter? Option A. Request the outstanding claims history information from the applicant and explain the necessity for its provision before a decision can be made. Option B. Decline the application immediately due to the incomplete documentation, citing the applicant's inability to provide information promptly. Option C. Advise the applicant that the policy can only be issued with a significantly higher premium to account for the unknown claims history. Option D. Proceed with underwriting the policy based on the information available, making reasonable assumptions about the missing claims history. The correct answer is D. Proceed with underwriting the policy based on the information available, making reasonable assumptions about the missing claims history. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need to secure new business with the fundamental principles of underwriting, specifically the principle of utmost good faith and the insurer's obligation to assess risk accurately. The underwriter must avoid making assumptions or accepting business without sufficient information, as this can lead to adverse selection and financial losses for the insurer and potentially misrepresentation claims from the client. The correct approach involves requesting the outstanding information from the applicant before making a decision. This upholds the principle of utmost good faith by ensuring both parties are acting honestly and transparently. It also aligns with the underwriting principle of accurate risk assessment, as the insurer cannot properly evaluate the risk without all relevant details. This approach demonstrates professional diligence and adherence to regulatory expectations that insurers must conduct their business responsibly and with integrity. An incorrect approach would be to proceed with underwriting without the requested information, assuming the missing details are not significant. This fails to uphold the principle of utmost good faith, as it involves making a decision based on incomplete knowledge, potentially misleading the applicant and the insurer. It also breaches the duty of care and risk assessment, as the underwriter has not fulfilled their obligation to gather all necessary information to determine the appropriate premium and terms. This could lead to the insurer accepting a risk it cannot profitably underwrite, or charging an inadequate premium, which is detrimental to the insurer's financial stability and potentially to other policyholders. Another incorrect approach would be to decline the application solely based on the applicant's inability to provide the information immediately, without offering a reasonable opportunity to do so. While thoroughness is important, an overly rigid stance without exploring alternatives or offering assistance can be seen as poor customer service and may not align with the insurer's duty to act fairly. However, in this specific scenario, the primary failure lies in proceeding without the information. The professional decision-making process in such situations should involve a clear understanding of the underwriting guidelines and the applicant's circumstances. The underwriter should first identify the critical missing information and its potential impact on the risk assessment. They should then communicate clearly with the applicant, explaining why the information is needed and the consequences of not providing it. If the applicant struggles to provide the information, the underwriter should explore reasonable alternatives or offer assistance where appropriate, while always prioritizing the accurate assessment of risk and adherence to regulatory requirements. The ultimate decision should be based on a comprehensive understanding of the risk, not on expediency or the desire to secure business. Question 11. System analysis indicates that a policyholder has lodged a claim following a minor motor vehicle accident. The policyholder has provided a brief description of the incident, and indicated that their vehicle sustained superficial damage. The insurer's claims handler is considering the next steps in processing this claim. Which of the following approaches best aligns with the regulatory framework and ethical obligations for handling such a claim in Australia? Option A. Demanding extensive photographic evidence of the damage from multiple angles, a full service history of the vehicle, and a witness statement from anyone who may have observed the incident, regardless of its apparent minor nature. Option B. Assuming the claim is minor and will not exceed the policy excess, and therefore closing the claim file without further investigation or communication with the policyholder. Option C. Requesting a detailed repair quote from an approved repairer, a police report if available, and a signed statement from the policyholder outlining the sequence of events, then assessing the claim based on this information. Option D. Immediately approving the claim for the estimated cost of minor repairs without requesting any further documentation to ensure a swift settlement. The correct answer is C. Requesting a detailed repair quote from an approved repairer, a police report if available, and a signed statement from the policyholder outlining the sequence of events, then assessing the claim based on this information. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need for accurate information with the policyholder's right to a fair and timely claims process. The core tension lies in gathering sufficient evidence to validate a claim without unduly delaying or obstructing the settlement process, which could lead to reputational damage and potential breaches of regulatory obligations. Careful judgment is required to ensure that the investigation remains proportionate to the claim's complexity and value, and that all actions are conducted with integrity and in accordance with the principles of good faith and fair dealing. The correct approach involves a thorough yet efficient investigation that prioritizes gathering all necessary information to assess the claim's validity and quantum. This includes obtaining a detailed report from the claimant, interviewing relevant parties, and potentially engaging independent experts if required. The investigation should be conducted promptly and without unnecessary delay, with clear communication maintained with the policyholder throughout the process. This aligns with the regulatory expectation under Australian consumer law and general insurance industry codes of practice that insurers must handle claims efficiently, fairly, and in good faith. The focus is on obtaining sufficient information to make an informed decision, not on creating obstacles. An incorrect approach that focuses solely on minimizing the insurer's payout by seeking excessive or irrelevant documentation would be professionally unacceptable. This could be seen as a breach of the duty of good faith, potentially leading to allegations of unconscionable conduct. Such an approach fails to recognize the policyholder's reasonable expectations and could result in a protracted and stressful claims experience, damaging the insurer's reputation. Another incorrect approach that prioritizes speed over thoroughness, leading to a premature settlement without adequate investigation, is also professionally unacceptable. This could result in underpayment of a legitimate claim or, conversely, overpayment due to insufficient scrutiny. Both outcomes expose the insurer to regulatory scrutiny and potential financial loss, and more importantly, fail to uphold the principles of fairness and accuracy in claims handling. A third incorrect approach that involves making assumptions about the claim's validity without conducting a proper investigation would be a significant regulatory and ethical failure. This demonstrates a lack of due diligence and could lead to the rejection of a valid claim or the acceptance of a fraudulent one, both of which are detrimental to the insurer and its policyholders. The professional decision-making process for similar situations should involve a systematic evaluation of the claim's circumstances, the policy terms and conditions, and the relevant regulatory requirements. Insurers should adopt a risk-based approach to investigation, tailoring the depth and scope of inquiry to the specific claim. Maintaining clear internal procedures, providing ongoing training to claims staff, and fostering a culture of ethical conduct and customer centricity are crucial for navigating these challenges effectively. Question 12. Market research demonstrates that a particular demographic group has a statistically higher incidence of certain lifestyle-related health issues. An underwriter is reviewing an application for a life insurance policy from an individual within this demographic. Which approach best aligns with Australian regulatory requirements and professional underwriting standards? Option A. Offer a standard premium to all applicants within that demographic group to remain competitive, without conducting a detailed individual risk assessment. Option B. Focus solely on the applicant's occupation and financial stability, as these are the primary drivers of risk for life insurance, and disregard any health-related information. Option C. Decline the application or significantly increase the premium based on the statistical data for the demographic group, assuming the applicant is likely to have similar health predispositions. Option D. Assess the applicant's individual health history, lifestyle choices, and medical records to determine their personal risk profile, irrespective of their demographic group. The correct answer is C. Decline the application or significantly increase the premium based on the statistical data for the demographic group, assuming the applicant is likely to have similar health predispositions. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the need to assess risk accurately with the imperative to avoid discriminatory practices, which are strictly regulated in Australia. The underwriter must rely on objective, quantifiable data directly related to the risk being insured, rather than making assumptions based on protected characteristics. The correct approach involves an underwriter meticulously reviewing the applicant's specific circumstances and the inherent risks associated with the proposed insurance, using only relevant and verifiable information. This aligns with the principles of fair and responsible underwriting, as mandated by Australian insurance regulations, which prohibit unfair discrimination. The underwriter's decision must be based on actuarial data and risk assessment principles, ensuring that premiums and terms reflect the actual risk presented by the individual or entity, not their membership in a particular group. This approach upholds the integrity of the insurance market and consumer trust. An incorrect approach that relies on generalized assumptions about a particular demographic group is professionally unacceptable. This fails to adhere to the Australian regulatory framework, specifically the principles of fair treatment and non-discrimination. Such an approach can lead to unfair pricing, denial of cover, and potential breaches of consumer protection laws. It also undermines the actuarial basis of insurance, which is designed to price risk based on individual or specific group characteristics demonstrably linked to increased probability of claims, not on broad, unsubstantiated stereotypes. Another incorrect approach that prioritizes market share or competitive pricing over accurate risk assessment is also professionally unsound. While commercial considerations are important, they must not compromise the fundamental duty to underwrite responsibly. Ignoring or downplaying significant risk factors to offer a more attractive price can lead to adverse selection, where high-risk individuals are disproportionately attracted to the product, ultimately destabilizing the insurer's financial position and potentially leading to future premium increases for all policyholders. This also contravenes the regulatory expectation that insurers operate on a sound financial basis. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes identifying all relevant risk factors, gathering objective and verifiable data, applying established underwriting guidelines and actuarial principles, and ensuring the decision is free from bias and discrimination. If there is any doubt about the relevance or legality of a particular factor, the underwriter should consult with senior colleagues or legal/compliance departments to ensure adherence to all Australian regulatory requirements and ethical standards. Question 13. Risk assessment procedures indicate that a client is seeking to purchase a new motor vehicle insurance policy. The client mentions they have a budget in mind and have seen a particular policy advertised that seems to offer good value. Which of the following approaches best demonstrates a thorough client needs analysis in this situation? Option A. Asking the client about their driving history, the type of vehicle they are purchasing, their typical usage of the vehicle, and any specific concerns they have about potential risks before discussing policy options. Option B. Recommending the advertised policy immediately as the client has expressed interest and has a budget in mind. Option C. Suggesting a basic comprehensive policy that fits within the client's stated budget, assuming this will cover most common risks. Option D. Explaining the features of the advertised policy in detail and highlighting its cost-effectiveness compared to other general market options. Correct answer is B. Recommending the advertised policy immediately as the client has expressed interest and has a budget in mind. Explanation: this scenario is professionally challenging because it requires an insurance representative to balance the immediate need to secure a sale with the fundamental regulatory and ethical obligation to thoroughly understand and address a client's actual needs. Failing to conduct a comprehensive client needs analysis can lead to the client being inadequately insured, potentially facing significant financial hardship if a claim arises, and can result in regulatory breaches and reputational damage for the representative and their organization. The correct approach involves actively listening to the client, asking probing questions about their financial situation, lifestyle, family responsibilities, and future aspirations, and then using this information to identify potential risks and recommend appropriate insurance solutions. This aligns with the principles of responsible financial advice and the regulatory expectation that financial services professionals act in the best interests of their clients. Specifically, under Australian regulations governing financial services, such as those overseen by the Australian Securities and Investments Commission, ASIC, representatives have a duty to ensure that advice provided is appropriate to the client's personal circumstances and needs. This includes a thorough fact-finding process to understand the client's objectives, financial situation, and needs. An incorrect approach would be to assume the client's needs based on a superficial understanding, or to push a product that is readily available or offers higher commission without verifying its suitability. This demonstrates a failure to conduct adequate due diligence and can lead to the client being sold a policy that does not meet their requirements, thereby breaching the duty to act in the client's best interests. Another incorrect approach would be to focus solely on the client's stated preference for a particular product, without exploring the underlying reasons or considering alternative solutions that might offer better protection or value. This bypasses the critical step of needs identification and can result in a misaligned product recommendation. Professionals should employ a structured approach to client needs analysis, starting with open-ended questions to encourage the client to share information, followed by specific, targeted questions to clarify details. They should then summarize their understanding of the client's needs to ensure accuracy before proposing any solutions. This process ensures that recommendations are evidence-based, client-centric, and compliant with regulatory obligations. Question 14. Process analysis reveals that a new product launch is imminent, and the team responsible for its risk management is under significant pressure to implement controls quickly. They have identified several potential risks associated with the product's distribution channels. Which of the following approaches best reflects a compliant and effective risk management process in this context? Option A. Conduct a detailed assessment of the likelihood and impact of each identified risk, develop specific controls tailored to the most significant risks, and establish a plan for ongoing monitoring and review of control effectiveness. Option B. Immediately implement a range of generic controls across all identified distribution channels to ensure some level of protection is in place before launch. Option C. Implement controls based on anecdotal evidence of similar products in the market, without a formal assessment of the specific risks for this new product. Option D. Focus on documenting all identified risks thoroughly, assuming that awareness of the risks is sufficient to manage them. The correct answer is B. Immediately implement a range of generic controls across all identified distribution channels to ensure some level of protection is in place before launch. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the insurance business to balance the need for efficient risk management with the imperative to comply with regulatory requirements and maintain ethical standards. The pressure to quickly implement controls without thorough assessment can lead to ineffective risk mitigation and potential breaches of regulatory obligations, impacting client trust and the company's reputation. Careful judgment is required to ensure that risk management processes are robust, compliant, and aligned with the company's strategic objectives. Correct approach analysis. The correct approach involves a systematic and documented process of identifying potential risks, assessing their likelihood and impact, implementing appropriate controls, and then continuously monitoring their effectiveness. This aligns with the principles of sound risk management expected within the Australian financial services regulatory framework, as underpinned by bodies like ASIC. Specifically, the Insurance Contracts Act 1984, CTH, and related prudential standards, if applicable to the specific entity type, emphasize the need for insurers to manage risks prudently. A thorough identification and assessment phase ensures that resources are directed towards the most significant risks, and that controls are proportionate and effective. Continuous monitoring allows for adaptation to changing risk landscapes and ensures ongoing compliance with regulatory expectations for risk management. Incorrect approach is analysis. An approach that prioritizes immediate implementation of controls without a proper risk assessment is procedurally flawed. This fails to ensure that the controls are relevant or effective against the identified risks, potentially leading to wasted resources or, worse, a false sense of security, while significant risks remain unaddressed. This can contravene the general duty of care and diligence expected of financial services licensees under the Corporations Act 2001, CTH, and ANZIIF regulatory guides concerning risk management. An approach that focuses solely on identifying risks without implementing or monitoring controls neglects a crucial part of the risk management cycle. While identification is the first step, it is insufficient on its own to mitigate potential harm. This oversight can lead to a failure to meet the prudential requirements for managing risks, potentially exposing the business and its clients to unacceptable levels of exposure. An approach that involves implementing controls without any form of documentation or review is also problematic. Lack of documentation hinders accountability, makes it difficult to demonstrate compliance to regulators, and prevents learning from past experiences. This can be seen as a failure to establish and maintain adequate risk management systems, which is a core expectation under Australian financial services regulation. Professional reasoning. Professionals should adopt a structured, iterative, and documented approach to risk management. This involves clearly defining each stage of the process: identification, assessment, control, and monitoring. When faced with time pressures, it is crucial to resist the temptation to bypass essential steps like thorough assessment and documentation. Instead, professionals should advocate for adequate time and resources to complete the risk management cycle effectively. This involves clear communication with stakeholders about the importance of each stage and the potential consequences of shortcuts. A risk management framework that is embedded within the organization's culture and operation, and which is regularly reviewed and updated, is essential for long-term success and regulatory compliance. Question 15. The audit findings indicate a potential for unconscious bias in the application of underwriting guidelines, leading to inconsistent risk assessments for similar applicant profiles. This raises concerns about fair treatment and compliance with regulatory expectations for insurance providers in Australia. Which of the following actions best addresses this situation from a stakeholder perspective, considering the insurer's obligations? Option A. Focus on updating the insurer's marketing materials to emphasize diversity and inclusion, believing this will indirectly influence underwriting practices towards greater fairness. Option B. Prioritize the development of new, more complex underwriting tools that rely heavily on automated data analysis, with the expectation that this will remove human subjectivity from the process. Option C. Conduct a comprehensive review of all underwriting guidelines and training materials to identify and eliminate any language or criteria that could inadvertently lead to discriminatory outcomes, followed by mandatory, targeted training for all underwriting staff on fair and objective risk assessment principles. Option D. Issue a directive to all underwriters to be more vigilant in their assessments, assuming that individual underwriters will self-correct any perceived biases without further procedural changes or training. Correct answer is C. Conduct a comprehensive review of all underwriting guidelines and training materials to identify and eliminate any language or criteria that could inadvertently lead to discriminatory outcomes, followed by mandatory, targeted training for all underwriting staff on fair and objective risk assessment principles. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the insurer's need for accurate risk assessment with the potential for bias and the ethical obligation to treat all applicants fairly. The audit findings highlight a systemic issue that could lead to discriminatory underwriting practices, which are strictly prohibited under Australian insurance law and regulatory guidelines. Careful judgment is required to ensure that underwriting decisions are based solely on relevant risk factors and not on protected characteristics. The correct approach involves a thorough review of the underwriting guidelines and training materials to identify and rectify any language or practices that could lead to bias. This includes ensuring that all underwriting criteria are objective, measurable, and directly related to the risk being insured. The underwriter must then implement a robust training program for all staff involved in underwriting to educate them on fair and ethical underwriting practices, as well as the legal and regulatory requirements. This approach aligns with the principles of fairness and non-discrimination mandated by Australian consumer protection laws and the Australian Securities and Investments Commission, a SIC regulatory framework for financial services. Specifically, it addresses the need for transparency, fairness, and responsible conduct in financial dealings. An incorrect approach would be to dismiss the audit findings as minor or to assume that the existing guidelines are sufficient without further investigation. This fails to acknowledge the potential for unconscious bias or misinterpretation of existing rules, which can still lead to discriminatory outcomes. Such an approach risks contravening the spirit and letter of Australian anti-discrimination legislation and ASIC expectations for responsible conduct. Another incorrect approach would be to implement a blanket policy change without understanding the root cause of the audit findings. This could lead to unintended consequences, such as making it more difficult to accurately assess risk or creating new avenues for unfair treatment. It also fails to address the underlying issue of potential bias in the underwriting process. A further incorrect approach would be to focus solely on the financial implications of the audit findings without considering the ethical and legal ramifications. While cost-effectiveness is important, it should not come at the expense of fair treatment and compliance with regulatory obligations. This approach neglects the fundamental duty of care owed to consumers and the insurer's responsibility to uphold public trust. Professional decision-making process for similar situations should involve a systematic approach. 1. Acknowledge and investigate audit findings thoroughly. 2. Identify the root causes of any identified issues, considering both systemic and individual factors. 3. Consult relevant regulatory frameworks, laws, and internal policies. 4. Develop and implement solutions that are compliant, ethical, and effective in addressing the identified problems. 5. Provide comprehensive training and ongoing monitoring to ensure adherence to best practices. 6. Regularly review and update policies and procedures to maintain compliance and fairness. Question 16. Cost-benefit analysis shows that reporting a minor, unconfirmed integrity lapse by a colleague might lead to internal friction and a slight delay in processing a client's application, potentially impacting the team's quarterly targets. However, not reporting it could mean a breach of ethical conduct goes unaddressed, potentially leading to larger issues down the line. Which approach best upholds the principles of integrity within the Australian financial services regulatory framework? Option A. Justify not reporting the lapse by observing that similar practices are common among other teams within the industry. Option B. Address the integrity lapse only if it directly impacts the company's profitability or if a client formally complains about it. Option C. Ignore the lapse, assuming it is insignificant and unlikely to cause any real harm, and focus on meeting the team's quarterly targets. Option D. Proactively report the lapse through appropriate internal channels and advocate for corrective action to be taken, even if it causes minor internal disruption. The correct answer is D. Proactively report the lapse through appropriate internal channels and advocate for corrective action to be taken, even if it causes minor internal disruption. Explanation. This scenario presents a professional challenge because it requires balancing business objectives with fundamental ethical obligations. The temptation to overlook a minor integrity lapse for perceived short-term gain is a common pitfall in financial services. However, the ANZIIF Foundation Certificate in Insurance Business Fundamentals for Financial Services, FSB 44-15, exam, emphasizes that integrity is not merely a desirable trait, but a foundational requirement for trust and the long-term sustainability of the financial services industry. Upholding integrity, even when inconvenient or seemingly costly, is paramount. The correct approach involves proactively addressing the identified integrity lapse by reporting it through appropriate channels and ensuring corrective action is taken. This aligns with the core principles of ethical conduct expected within the Australian financial services regulatory framework, which prioritizes consumer protection and market integrity. Specifically, the Corporations Act 2001, CTH, and the ASIC Act 2001, CTH, mandate that financial services licensees and their representatives act with honesty and integrity. Reporting such issues demonstrates a commitment to these principles, fosters a culture of accountability, and prevents potential harm to clients or the broader market. It also aligns with the professional standards expected of individuals operating within the financial services sector, where trust is the currency. An incorrect approach that involves ignoring the integrity lapse, even if it appears minor and unlikely to cause immediate harm, represents a significant ethical and regulatory failure. This failure stems from a disregard for the duty to act honestly and with integrity, as required by Australian law. Such inaction can lead to a gradual erosion of ethical standards within an organization and expose it to reputational damage and potential regulatory sanctions if discovered. Furthermore, it undermines the trust that clients place in financial service providers. Another incorrect approach, which is to only address the issue if it directly impacts profitability or if a complaint is lodged, is also professionally unacceptable. This reactive stance demonstrates a lack of proactive ethical responsibility. The regulatory framework expects individuals to identify and address potential integrity issues regardless of immediate financial consequences. Waiting for a problem to escalate or for external pressure to mount is a failure to uphold the duty of care and the obligation to act in the best interests of clients and the integrity of the market. A further incorrect approach, which is to justify the lapse by claiming it is common practice within the industry, is a dangerous rationalization. The fact that a practice may be widespread does not make it ethical or legal. The regulatory framework in Australia is designed to set a high standard of conduct, and relying on industry norms that fall short of these standards is a clear abdication of professional responsibility. This approach ignores the fundamental obligation to adhere to legal and ethical requirements, regardless of peer behavior. The professional decision-making process for similar situations should involve a clear assessment of the situation against established ethical principles and regulatory requirements. Professionals should ask themselves, does this action or inaction align with my duty to act honestly and with integrity? What are the potential consequences for clients, the organization, and the market if this issue is not addressed? What does the relevant legislation and regulatory guidance require me to do? If there is any doubt, seeking guidance from supervisors or compliance departments is essential. Prioritizing integrity, even when it presents short-term challenges, is crucial for maintaining professional credibility and ensuring the long-term health of the financial services sector. Question 17. The evaluation methodology shows that an underwriter is considering using a new data analytics tool to assess risk more efficiently. This tool incorporates a wide range of data points, including social media activity and postcode data, to predict the likelihood of a claim. The underwriter needs to determine the most appropriate approach to adopting this tool, considering the regulatory framework for financial services in Australia. Option A. Seek external validation of the tool's predictive accuracy from industry peers without independently verifying the ethical implications of the data used. Option B. Focus on the tool's accuracy in predicting claims and prioritize its adoption based on its potential to reduce claims payouts, with minimal consideration for the specific data inputs beyond their legal acquisition. Option C. Conduct a thorough review of the data sources and the analytical model to identify any potential for bias or discriminatory outcomes, ensuring compliance with Australian anti-discrimination laws and fair treatment principles before implementation. Option D. Implement the data analytics tool immediately to leverage its predictive capabilities and improve underwriting efficiency, assuming the data is legally obtained. The correct answer is D. Implement the data analytics tool immediately to leverage its predictive capabilities and improve underwriting efficiency, assuming the data is legally obtained. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the potential benefits of advanced data analytics in risk assessment with the imperative to adhere to regulatory requirements and ethical considerations, particularly concerning fairness and non-discrimination. The ANZIIF Foundation Certificate in Insurance Business Fundamentals for Financial Services, FSB 44-15, exam emphasizes understanding these foundational principles within the Australian regulatory landscape. Careful judgment is required to ensure that the application of data analytics does not inadvertently lead to unfair outcomes for consumers. The correct approach involves a thorough review of the data sources and analytical models to ensure they do not rely on or perpetuate prohibited discriminatory factors, aligning with principles of fairness and consumer protection as expected under Australian insurance law and regulatory guidance. This approach prioritizes the ethical and legal implications of data usage, ensuring that underwriting decisions are based on relevant risk factors and not on proxies for protected characteristics. It demonstrates a commitment to responsible data analytics, which is crucial for maintaining consumer trust and regulatory compliance. An incorrect approach that relies solely on the predictive power of data analytics without scrutinizing the underlying data for potential biases or discriminatory elements fails to meet regulatory expectations. This could lead to breaches of anti-discrimination legislation and the Australian consumer law, which prohibit unfair treatment of consumers. Another incorrect approach that prioritizes speed and efficiency of underwriting over the ethical implications of data usage risks, overlooking potential unfairness. This demonstrates a lack of due diligence and a failure to uphold the professional responsibility to treat customers fairly. A core tenet of financial services regulation in Australia. Professionals should adopt a decision-making framework that begins with understanding the regulatory obligations and ethical principles governing insurance underwriting. This involves critically evaluating the data and analytical methods used, seeking to identify and mitigate any potential for unfair discrimination. When in doubt, seeking guidance from compliance or legal departments, or consulting relevant regulatory guidelines, is a crucial step in ensuring that data analytics is applied responsibly and ethically. Question 18. Stakeholder feedback indicates that a client has requested a specific insurance product that is known to be offered by a provider with whom your firm has a referral fee arrangement. You are aware that accepting this referral fee would provide a financial benefit to your firm. How should you proceed to ensure compliance with professional standards and regulatory obligations? Option A. Proceed with recommending the product as requested by the client, accepting the referral fee, and assuming the client's satisfaction with the product outweighs any disclosure concerns. Option B. Decline to recommend the product due to the referral fee arrangement, without thoroughly investigating if the product genuinely meets the client's needs or exploring alternative solutions that might be suitable. Option C. Accept the referral fee and recommend the product without any disclosure to the client, believing that the client's request is sufficient justification for the recommendation. Option D. Disclose the referral fee arrangement to the client and explain how it might influence the recommendation, allowing the client to make an informed decision about proceeding with the product or exploring alternatives. The correct answer is D. Disclose the referral fee arrangement to the client and explain how it might influence the recommendation, allowing the client to make an informed decision about proceeding with the product or exploring alternatives. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance competing interests: the client's immediate desire for a specific product and the professional obligation to ensure the client's needs are met ethically and in accordance with regulatory requirements. The challenge lies in identifying and acting upon potential conflicts of interest and ensuring that advice provided is objective and in the client's best interest, rather than driven by potential personal gain or ease of transaction. Careful judgment is required to navigate the fine line between facilitating a sale and upholding professional integrity. The correct approach involves proactively identifying the potential conflict of interest arising from the referral fee and disclosing it transparently to the client. This approach upholds the principle of acting in the client's best interest, a core tenet of professional conduct and regulatory expectations in financial services. Specifically, under Australian financial services regulation, particularly as it relates to the Corporations Act 2001, CTH, and associated ASIC regulatory guides, financial advisors have a duty to act in the best interests of their clients. This includes a requirement to manage conflicts of interest. By disclosing the referral fee, the professional allows the client to make an informed decision, understanding any potential bias. This aligns with the ethical standards expected of professionals in the financial services industry, promoting trust and transparency. An incorrect approach would be to proceed with the recommendation without disclosing the referral fee. This failure to disclose a material fact that could influence the client's decision constitutes a breach of the duty to act in the client's best interests. It creates a hidden conflict of interest, potentially leading the client to believe the recommendation is solely based on merit, when it is also influenced by a financial incentive to the referrer. This is a direct contravention of regulatory obligations regarding disclosure and conflicts of interest. Another incorrect approach would be to dismiss the client's request for the specific product without thoroughly investigating whether it genuinely meets their needs, simply because a referral fee is involved. While avoiding conflicts is important, professionals must still provide appropriate advice. Ignoring a client's stated preference without a valid, client-centric reason, and without exploring alternatives that might satisfy their needs while managing the conflict, is also a failure to act in the client's best interests. It can be seen as paternalistic and not client-focused. A further incorrect approach would be to accept the referral fee and proceed with the recommendation, assuming the client would not be concerned. This approach demonstrates a disregard for the client's right to full information and the professional's obligation to manage conflicts of interest. It prioritizes personal or firm benefit over client welfare and transparency, undermining the integrity of the advice provided and potentially leading to regulatory breaches and reputational damage. The professional decision-making process for similar situations should involve a clear framework. 1. Identify potential conflicts of interest. Always be aware of any personal or organizational financial incentives that could influence advice. 2. Assess the impact of the conflict. Determine how the conflict might affect the objectivity and fairness of the advice. 3. Disclose transparently. Inform the client about the conflict in a clear, understandable, and timely manner. 4. Seek client consent. Obtain the client's informed consent to proceed after disclosure. 5. Manage or avoid the conflict. If consent cannot be obtained or the conflict is too significant, explore ways to manage it, e.g., by not accepting the fee or avoid it altogether. 6. Document all decisions and communications. Maintain records of the conflict, disclosure, and client's decision. Question 19. Governance review demonstrates that the insurance business's customer onboarding process has been streamlined to improve efficiency. However, concerns have been raised regarding the adequacy of its anti-money laundering and counter-terrorism financing, AML/CTF, controls. Which of the following approaches best aligns with the requirements of the Australian AML/CTF regulatory framework for customer identification and ongoing due diligence? Option A. Focusing solely on initial customer identification and assuming that once a customer is onboarded, their risk profile remains static, thereby eliminating the need for ongoing due diligence or transaction monitoring. Option B. Applying a standardized, simplified identification process for all new customers, regardless of their perceived risk, and conducting minimal ongoing monitoring once the initial onboarding is complete. Option C. Prioritizing the speed of customer onboarding by accepting self-declaration of identity for all customers and deferring comprehensive verification to a later, unspecified date, while neglecting ongoing transaction monitoring. Option D. Implementing a risk-based approach to customer identification, where the level of verification is proportionate to the assessed risk of money laundering or terrorism financing, and conducting ongoing due diligence to monitor for unusual or suspicious activity throughout the customer relationship. The correct answer is D. Implementing a risk-based approach to customer identification, where the level of verification is proportionate to the assessed risk of money laundering or terrorism financing, and conducting ongoing due diligence to monitor for unusual or suspicious activity throughout the customer relationship. Explanation: this scenario is professionally challenging because it requires the insurance business to balance its operational efficiency with its legal and ethical obligations under Australia's anti-money laundering and counter-terrorism financing, AML/CTF, regime, specifically as governed by the Anti-Money Laundering and Counter-Terrorism Financing Act 2006, CTH, and related rules. The challenge lies in identifying and mitigating the risks associated with customer onboarding and ongoing transactions without unduly hindering legitimate business activities. Careful judgment is required to ensure that the implemented measures are both effective in preventing financial crime and proportionate to the identified risks. The correct approach involves a risk-based assessment of customer identification procedures. This means that the level of scrutiny applied to a customer should be directly related to the money laundering or terrorism financing risk they present. For low-risk customers, simplified identification procedures may be appropriate, while high-risk customers would require more rigorous verification. This aligns with the principles of the AML/CTF Act, which mandates that reporting entities establish and maintain a risk-based AML/CTF program. This approach ensures compliance by focusing resources where the risk is greatest, thereby enhancing the effectiveness of AML/CTF controls. An incorrect approach that relies solely on a one-size-fits-all identification process for all customers fails to acknowledge the varying levels of risk. This can lead to inefficient use of resources by applying excessive scrutiny to low-risk individuals and potentially overlooking subtle indicators of higher risk in other cases. Ethically, it may also create an unfair burden on low-risk customers. Another incorrect approach that involves neglecting ongoing customer due diligence for established clients is also professionally unacceptable. The AML/CTF Act requires reporting entities to have systems in place to monitor transactions and identify any unusual or suspicious activity. Failing to conduct ongoing due diligence means that the business is not actively managing its AML/CTF risk over the life of the customer relationship, leaving it vulnerable to exploitation by criminals who may attempt to use existing accounts for illicit purposes. This is a direct contravention of the Act's requirements for a comprehensive AML/CTF program. A third incorrect approach that prioritizes speed of customer onboarding over thoroughness of identification, even for high-risk customers, is a significant regulatory and ethical failure. The AML/CTF Act places a strong emphasis on verifying customer identity to prevent the use of the financial system for illegal activities. Expediting onboarding at the expense of robust verification, particularly for those deemed higher risk, directly undermines the purpose of AML/CTF regulations and exposes the business to severe penalties, reputational damage, and the risk of facilitating financial crime. The professional decision-making process for similar situations should involve a thorough understanding of the AML/CTF Act and its associated rules. This includes conducting a comprehensive risk assessment to identify potential money laundering and terrorism financing threats relevant to the business's operations and customer base. Based on this assessment, the business should develop and implement a risk-based AML/CTF program that includes appropriate customer identification procedures, ongoing customer due diligence, and suspicious matter reporting obligations. Regular review and updating of the program are also crucial to ensure its continued effectiveness in a dynamic threat environment. Question 20. Compliance review shows that during a call to lodge a claim, a customer is audibly distressed and speaking with a tremor in their voice. The insurance representative needs to gather specific details about the incident to process the claim. Which approach best demonstrates professional conduct and adherence to customer service expectations? Option A. Immediately begin asking detailed questions about the incident, explaining that the information is critical for claim processing, and gently but firmly steer the conversation towards the required data points. Option B. Acknowledge the customer's distress by saying something like, "I can hear you're upset and I'm sorry to hear that. Let's take a moment, and when you're ready, we can go through the details together at your pace." Option C. Advise the customer to calm down before continuing the conversation, stating that it's difficult to understand them when they are emotional. Option D. Focus on the administrative process, explaining the policy terms and conditions related to the claim, and then ask for the incident details. Correct answer is A. Immediately begin asking detailed questions about the incident, explaining that the information is critical for claim processing, and gently but firmly steer the conversation towards the required data points. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need for accurate information with the customer's emotional state and potential vulnerability. The customer is experiencing distress, which can impact their ability to communicate clearly and their perception of the insurer's service. A failure to demonstrate empathy and active listening can lead to misunderstandings, customer dissatisfaction, and potential breaches of ethical conduct and regulatory expectations regarding fair treatment of customers. The correct approach involves actively listening to the customer's concerns, acknowledging their distress, and seeking to understand their situation before proceeding with the information gathering. This demonstrates empathy, builds trust, and ensures the customer feels heard and respected. From a regulatory and ethical perspective, this aligns with the principles of treating customers fairly, which is a fundamental expectation in the Australian financial services industry, as promoted by bodies like ANZIIF. It also reflects good business practice, fostering positive customer relationships and potentially leading to more accurate information being provided by a calmer customer. An incorrect approach that focuses solely on the transactional aspect of gathering information without acknowledging the customer's emotional state fails to demonstrate empathy. This can be perceived as cold or uncaring, potentially exacerbating the customer's distress and leading to a negative customer experience. Ethically, it falls short of the expected standard of care and professionalism. Another incorrect approach that involves interrupting the customer or dismissing their feelings in favor of immediate data collection is also professionally unacceptable. This demonstrates a lack of active listening and empathy, potentially alienating the customer and making them less likely to cooperate. Can also lead to incomplete or inaccurate information being gathered if the customer feels unheard or pressured. A professional decision-making framework in such situations should involve 1. Pause and observe. Recognize the customer's emotional cues. 2. Acknowledge and validate. Express understanding and empathy for their situation. 3. Active listening. Focus on understanding the core of their concerns, asking clarifying questions without judgment. 4. Information gathering with empathy. Once the customer feels heard, gently guide the conversation to gather necessary details, explaining why the information is needed. 5. Resolution and support. Offer appropriate solutions or next steps, ensuring the customer understands them. This framework prioritizes the customer's well-being and experience while still achieving the necessary business objectives, aligning with regulatory expectations for responsible conduct.